everyone, and welcome to episode 13 of the Property Investing Podcast, brought to you by Real Estate Investor. It's Dennis Wong here, and can you believe it's already December? You know, where has the time gone? And I hope your property investing has tracked well this year, and you've had some wins, and I hope these podcasts have been a useful educational tool for you. Now, please don't forget, if you want me to cover anything specific, to get in touch. You're welcome to email your request to info@realestateinvestor.com.au. Now, in this episode, I've invited a special guest to join me to talk about LVRs, and I'll also cover how to choose the best agent if you decide to sell. So, let's get straight into it. All right, in the next part of today's podcast, I'd like to welcome along Mitch McCabe, who is one of our consultants from our premium membership team, to talk to us about what LVR is and give us some insights on how you can take advantage of it and what the benefits of a lower LVR are. So we've recently had some inquiries, and for those that are new to property investing, I'm sure you're going to get a lot out of this. So Mitch, thanks so much for joining me on this episode of the Real Estate Investor Podcast.
Yeah, no worries. Thanks, Dennis. Thanks for having me, and hi to everyone out there.
So look, I guess before we get started, Mitch, you want to just tell us a little bit about your background and what you do at Real Estate Investor?
Yeah, okay. So my background is in financial planning, property consulting, and mortgage broking, which I guess is why I'm here today. So my role in the company is as a strategist is to sit down with clients and just have a chat about where they're at financially and what their goals are, and then we try to assess a way to help them fast track building their portfolio and get a bit more direction before we go out and help them find properties. So yeah, that's what I do here.
Fantastic. And so do you only help investors or property buyers that already have property, or do you also help people that are just starting out?
No, definitely both. So I've actually got a lot of experience with first home buyers. When I was doing property consulting in the past, in Queensland is where I'm based. I've done a lot of first home buyers, and at the time, which is still actually only just present now, we've got a $20,000 first homeowners grant. So
yep.
Yeah, I've done a lot of beginners and a lot of investors. So I can cover a broad range, I think.
Excellent. All right. Well, okay. Can you give us a little bit of a definition for our listeners on what LVR actually is and what it stands for?
Yeah, LVR is, it's pretty basic and simple. It's just loan to value ratio. So we're looking at how much of a loan we've got to the value of the actual property. And it's usually calculated in a percentage. So whether it be an LVR of 80% or 70% or 90% or 95% even for first home buyers.
Yep. And so how do you calculate that percentage?
It's basically just calculated between how much deposit somebody's putting on a property and compared to how much of a loan they're getting as well. So a typical ratio would be a 20% deposit of a property with an 80% LVR. So you've got 80% loan on that property. So to give you an example, a $400,000 property would have a deposit of $80,000, which will give them a 20% deposit, excluding costs as well.
Yeah. So you hear a lot, especially since APRA has obviously cranked down on lending, that most lenders need to have a target of an 80% LVR. So what happens if your LVR is over that 80%?
Yeah, definitely. It depends, again, on your occupation as well. I mean, some professionals, doctors, dentists and whatnot, will get a 90% LVR, and depending on which bank as well. But generally, 80% LVR will keep you out of the range of what we call LMI, or lender's mortgage insurance, which is an insurance that the bank will add on to their loan. And it's actually done through a separate company, not through their own bank. They actually get insurance to cover any sort of risk, to cover any gap if you were to, say, falter on your loan.
Yep.
Because as you imagine, if you've got a property and you put a 5% deposit down on, let's say, a $500,000 property, I mean, you've got quite a big exposure there, or the bank has quite a big exposure at owning 95% of that. So if they have to sell it quick, they look at a fire sale, and then that's how they sort of calculate, I guess, their risk exposure, and that's when LMI comes in. And it's lender's mortgage insurance.
And can that be expensive?
It can be, yes. You can look at, if you were looking at a loan that's, say, 81%, you might only have insurance of LMI of $2,000, which is generally just added on top of the loan.
Yeah.
But it can go up as high as 18,000, 19,000, probably even higher, depending on how high or how expensive your property is that you're purchasing. But a typical range for first home buyers I see is probably around 11,000, 12,000 that gets added onto the loan.
Yep.
But in some instances, it may be better to have a smaller deposit and add LMI to the loan.
Yep.
Just depends on what your personal circumstance is. So it can actually work better in your favour. But again, that's a case-by-case scenario.
And that's all about doing the numbers, isn't it? Just working out between the two scenarios and see which one works better for you.
Yeah, 100%. You might ask for a deposit of 80,000. You may be able to cut that deposit down to 50,000 and add insurance of 10,000 onto your loan. So you're saving yourself 30, but adding 10, so really is a $20,000 difference there that's in your pocket. So in some cases, it definitely can work out a little bit better.
So to be clear, I guess lender's mortgage insurance is to protect the bank, not the actual borrower. Is that right? That's
right. Yeah, it's the bank's insurance to cover them, which you will have to pay without fail if you go over an LVR ratio that they set out.
And so, look, if you've got a bit of extra cash, is it worthwhile then paying a 30% deposit instead, or does it really just depend on your situation?
Depends on your situation. Depends on your on your cash flow as well. Because keep in mind, the higher your loan is, the higher your repayments are going to be. If you're looking at an investment and you've got a small deposit down, and you're banking on your rental return to cover your repayments. If you've got a small deposit, your loan's higher, your repayments are going to be higher, and that's going to influence your cash flow of what's coming in and what's going out. So you'll probably find it be a lot more heavily negatively geared. Definitely it impacts quite a bit. But if you can do it, the general rule of thumb is obviously a 20% deposit is a safe bet, and that will keep you out of LMI, and that will keep your repayments pretty low. And if it's the right type of investment, then you'll be closer to positive or neutrally geared.
Yep. And so, look, as part of your role, Mitch, then do you give a little bit of advice or review clients' loan LVR ratios and what they can potentially do from a borrowing point of view?
Yeah, 100%. Look, I take a bigger picture of the whole scenario and where you're at financially and what's going to impact. But we do outsource for brokers as well who'll run the numbers. And they'll go into their system, and that'll relate to 40 different banks, and they'll see who's going to give you the best rate and how that's going to work. But yeah, look, I take a bigger picture and try to give a bit of advice on which way would work best for you and what sort of deposit would be needed to get the outcome that you're looking for. As I said, if you're looking for positive cash flow, then it may be better to look at a bigger deposit. Because that way you could be making an extra $50 a week on your rental return, excluding all of your costs and repayments.
Excellent. Well, look, Mitch, that's probably all the time that we have today. So thank you so much for joining me. For those out there listening, if you do have any inquiries about your borrowing capacity or about your LVR, about your portfolio, about what you want to do next, and you need a bit of help, we do offer the free consultation through our premium membership. So feel free to jump on our website, realestateinvestor.com.au, and you can book in for a free strategy session. And either Mitch or one of the consultants from the team will be in touch to book in a time. So thanks again, Mitch.
Perfect. Thanks, Dennis.
Now, when it comes to selling your property, having the right agent can mean a stress-free, timely, and profitable experience. And having a bad agent can cost you tens of thousands of dollars. So it's important that you do your research to ensure you pick the best agent to sell your property, just as if you were researching for your next property. So here are some of my tips to help you pick the best agent. Number one, look at the history in numbers. How many properties have they sold? How many are they currently selling? And what have the sale prices been? Make a list of at least 3 agents and look at their numbers. Once you've done that, make sure you organize an interview so you can go along and meet and ask them lots of questions. Number 2, Review their marketing strategies. How do they promote their listings? Will they use digital and print, or just one or the other? Do they use social media? What are the quality of their photos like on all their listings? What's their reach? Do they have international contacts? Number 3, are they locally based? This is going to give an agent a huge advantage because they're going to know the area, they're going to know the comparable sales, schools that are nearby, public transport, shops, cafes, the demand in the area, who is looking in the area, and future developments as well. Number 4, check out their performance. Go to an open home that they're running for another property and see how they present that property. How do they interact with their potential buyers? What's your first impression? What you're going to find is first impressions are going to be really important. This is going to give you an indication how likely they're going to present your property. Number 5, the time it takes to actually sell. In addition to looking at the numbers, find out what the agent's average days on market is. Just because an agent has the most sales, you want to know how long it's taken to achieve that. So the lower the number means a quicker sale. And finally, number 6, the level of discounting. Does the agent have a tendency to offer discounts before a property sells? Have a look at what the original asking price is for a property and then compare it to the eventual sale price. You don't want an agent who always discounts to be selling your property. They're going to be the ones that you want to buy from though. Now, the last 2 items isn't data that you can easily obtain from free sites, and some agents will be reluctant to tell you the true numbers, especially if they don't look favorable. If you're already a member of our Pro membership, you can view this data easily via the My Value, My Research tool. So make sure you take advantage of this information if you're looking at selling. So thank you so much for listening. That's another episode of the Property Investing Podcast from Real Estate Investor. Christmas is still a great time to keep your finger on the pulse because you may find that deal when everyone else is off on holidays. It'll definitely give you a head start for 2018. We'll have one more episode before we head off on the break. So until then, happy investing, and I'll catch you next time.